Now that you have learned the double entries related to the purchase of inventory as well as the sale of inventory, we can move on to the assumptions relating to cost of sale. In our syllabus, we learned about the first in, first out method of inventory valuation. Basically, the first in, first out is an assumption that goods purchased the earliest are sold first. Meaning what? Whatever you buy first, you will sell it first. So whatever is left in the inventory is the goods that is purchased last. Now let's take a look at what this means. Now imagine if I were to sell, so I am a fruit seller, all right, and I bought and I sell only oranges. So what happens is that I bought a batch of orange, 4 oranges in my first batch. In the second batch, I bought 5 oranges, and in my third batch, I bought 3 oranges. Now I sold some orange subsequently. I sold 9 oranges. So under the first in, first out method of inventory valuation, I sell the oranges which I purchased first. Which batches did I purchase first? I purchased batch 1 and batch 2 first. That means that I sold batch 1 first, and then I sold batch 2. So what does this mean? It means that my unsold inventory is my ending inventory. So this key point of whatever you bought first, you sold first. That is the first in, first out. Now let's take a look at an example of using FIFO or first in, first out to record inventory. So my business is squeegee oranges and I am a fruit shop selling oranges. For the month of May, the business recorded the following purchases and sales of inventory. I record my inventory using the FIFO method. So in the month of May, there was a credit purchase of inventory. On the 1st of May, 4 oranges. 4 oranges at $8. On the 13th of May, 5 oranges at $10. On the 25th of May, 3 oranges for $6. This is a credit purchase of inventory. What does credit purchase mean? Credit purchase means that I have not paid for my inventory yet. What about my sale of inventory? My sale inventory in the month of May relates to these items. On the 27th of May, I sold 4 inventory at $11. On the 31st of May, I sold 5 oranges at $13. Now, these are cash sales. Cash sales means that I receive cash when I sold my oranges. So, what do I need to do? So, the usual things that you are required to do are to prepare an inventory account for the month of June, to calculate what is the sales revenue, the cost of sales, the gross profit, and to say what is the value of ending inventory at the end of the month. So let's start with the first one, to prepare the inventory account for the month of June. If I were to prepare the inventory account for the month of June, I would have to take into account the credit purchase of inventory and the cash sale of inventory. Now let's do a recap of what these double entries are. When I sell inventory on credit, because when I purchase inventory on credit, because I bought inventory, I would record journal entries are inventory increase, inventory debit, because inventory is an asset, and I have to pay for the inventories. I owe somebody money. So trade payables credit or trade payables increase. When I sell inventory and I receive cash, these are the double entries. Now I do have to remember that there are 2 transactions when I sell my inventory. And we will talk about that later. Alright, so let's first record the credit purchase of inventory. When I buy inventory, these are the double entries. Right? I have to increase inventory, debit, and trade payables credit. So when I buy inventory, firstly, the accounting rule for inventory account is plus minus. That means that every time inventory increases, you have to record on the debit side. Every time it decreases, you have to record on the credit side. So how should I record this inventory? Purchase. Firstly, on the 1st of May, I bought 4 oranges at $8. Now, it should not be balance brought down. It should be trade payables. I made a mistake here. Let me cancel it and change it immediately. Cancel, cancel, cancel. Trade payables. Because horrible handwriting. Alright, so it should not be balance brought down. It should be trade payables. So I bought 4 oranges at $8, and I would have to record an increase in inventory. The other account affected is trade payables. So that means on 1st of May, I will record inventory debit $8, and trade payables is the other account affected. On the 13th of May, inventory increased by $10. The other account affected is trade payables. On the 25th of May, inventory increased by $6. The other account affected is trade payables. So this is the credit purchase of inventory. Now remember we had a cash purchase of inventory. So with a cash purchase of inventory, what are the double entry affected? So when I sell my inventory and I sell 4 inventory at $11 and 5 inventory at $13, what are the double entries affected? So the first thing I need to do when I sell my inventory, cash sale, I need to record sales revenue. So that would mean I need to increase my cash in hand because I receive cash. The other account affected is sales revenue. I earned an income, I earned sales revenue when I sold my oranges. So sales revenue increased by $11 for the first batch. Now after that, I need to release the cost of sales from inventory because these 4 oranges here, they are inventory, right? So I need to release it. I need to release this cost of sales. So the way I do that is I record a cost of sales plus debit expenses and I minus away inventory minus inventory credit. Now that's because inventory is now a cost of sales. The inventory has been changed into a cost of sale. So how should I use this to continue preparing my inventory account? So this is what happens. On the 27th of May, when I sold 4 oranges, this corresponds to the inventory that I bought on the 1st of May. And what I need to do is I need to transfer the 8th of May, the $8 from my inventory from the plus side into the negative side. Because I have sold the inventory is now converted into a cost of sale. Similarly, when I sold 5 inventory on the 31st of May, it is actually the second batch of inventory that I purchased on the 13th of May. And how I record this is I move the $10 from the debit side of inventory account into the credit side of inventory account because now this $10 has been changed into the cost of sales. So after that, what I do is I calculate my balance brought down, and my balance brought down is $6 debit. Now this $6 debit is the amount of inventory that I have left. And there you go. This is how I prepare my inventory account. Here is my inventory account. Now, usually you will also be asked to calculate the cost of sales, sales revenue, and the gross profit. So how should I calculate my sales revenue? Which one is the sales revenue? The cash sale of inventory. Now this amount here relates to your sales revenue. So when I calculate my sales revenue, I take $11 and $13. I add them together, and that will be my sales revenue of $24. Right, my cost of sales. My cost of sales relate to the amount of inventory that I sold, the cost price of the inventory that I sold, right? So remember, every time what is the cost of sale? The cost of sales is the cost of the inventory that has been released into the cost of sales for you to calculate your gross profit. So cost of sales are these two amounts, $8 and $10, because it is the 4 and 5 oranges which had been sold on the 27th and 31st of May. So cost of sales would be $8 plus $10, and I would get $18. Now, how do I calculate my gross profit? Gross profit is sales revenue minus cost of sales. $24 minus away $18, which would leave me $6. $6 is my gross profit. I earn $6 from buying and selling oranges. Now, finally, what is my ending inventory? Now, my ending inventory is the inventory that I have left that is unsold. So this relates to the 3 oranges that is unsold at the end of the month. And this is my ending inventory of $6. Now, actually, I can calculate my cost of sales as well as my ending inventory from my inventory account. Let's take a look how. How do I calculate my cost of sales from my inventory account? I need to look at my cost of sales number. All right, so these two double entry, which says cost of sales, right? So these two are my cost of sales for the month of May. I just need to add them up together to get $18. What about ending inventory? Ending inventory is the $6 that I have left at the end of the month. And this ending inventory is how do I know which one is it from inventory account? It is the balance brought down. The balance brought down will show me what the ending inventory is. So here you are, FIFO. Whatever you buy first, you sell first. That is something you need to remember when you prepare your inventory account and when you need to calculate your cost of sales.